Hello, ladies and gentlemen, hackers and traders. My name is Dr. J, and welcome to this, the third in our series about building a high-frequency trading system. Now, the first few videos in this channel were fairly high-level and fairly general, basically introducing the channel and talking about market making. Now, it's time to roll up our sleeves and start getting our hands dirty. Today, we are going to talk architecture. What are the bits and pieces that actually go into building a high-frequency trading system? From recording the prices of thousands of instruments, to building signals and actively trading with them, all the way to managing a fleet of hundreds or even thousands of servers in the cloud. It's going to be big. It's going to be fun. This is Hacking and Trading. Stay tuned. So here is a bird's eye view of the architecture to which we're going to be building our high-frequency trading system. As you can see, it is broken broadly into 8 parts, each of which will form the basis for the next 8 episodes where we will dive into each of them. The first area is where we do the foundational task of actually receiving and recording the market data from each of the exchanges. What are the various ways for exchanges to disseminate their market data? What do exchanges have in common so that we can build a system that can trade generically across a whole lot of them? And how do we design this so that it can be used both in the research area of our system and in the actual trading of those cryptocurrencies? The second area zooms in on exactly how we go about recording our market data, taking into account the cost of servers, the cost of internet bandwidth, and the cost of storing data in the cloud. It needs to be very scalable as there are thousands of instruments out there across hundreds of exchanges, and sometimes these instruments can be ticking hundreds or thousands of times every second. It also needs to be very reliable as any outages will sorely affect our simulations in the future when we want to be using this data that we recorded in the past. Third up is probably the most interesting part of high-frequency trading, and that is alpha generation. How do we algorithmically convert the market data that our algos can see into short predictions about the future? We will look at a couple of very simple signals so that you can get a taste for them. An important thing to notice about these signals is they can consume market data in 2 different ways. Firstly, directly from S3 storage or cloud storage. So this is the recorded data that we recorded in step 2. But more importantly, directly from the exchanges so that these same signals can be used when we're trading live. If enough people are interested, then eventually a large portion of this vlog series will zoom in on the wide variety of signals that make up the bulk of high-frequency trading alpha generation. That's going to be very exciting. Tell your friends to subscribe today. So once we have some signals, thousands of signals, we're going to turn to machine learning to help select from all those signals which is the best set of them to help predict the future of a particular market. If a few signals are good at predicting the future, surely an intelligent combination of them, a combination of the best of them, will be an even better prediction of the future, right? We'll look at several techniques of combining or selecting and combining these signals, from the simplest regressions to some more recent inventions like XGBoost. So by now, we believe that our signals can tell us the future trajectory of the price of one of the cryptocurrencies. So how do we turn that prediction into actual hard US dollar cash? Well, the 5th section talks about order management. This is the logic that submits buy and sell trades into the market so that we hope that someone with an exactly opposing view to ours will take us up on our offer to trade. More importantly, we'll explore what we should do with those orders when our prediction of the future changes. Should we leave them there? Should we be cancelling them? How quickly should we be cancelling them? These are all important questions to consider when doing order management. Now, while it's a lot less sensational and sexy than the signal generation that we're looking at in section 3, order management is probably the second most important part of any high-frequency trading system. So take care to pay attention to this section. Okay, now the rubber is starting to hit the road. Section 6 covers simulation. In a naive world, you can code up an algo, set it live, and wait a few hours to see if it's profitable. Or maybe find out that it has a bug in it and you've just burned through $10,000. But that would be crazy, right? In reality, we need a mechanism to try out our algos before we put them live. This will help both with our flushing bugs out, but also more importantly, to explore a set of parameters that might be able to squeeze a bit more of that profit out of the order management system. This is stuff we weren't able to do during regression. This is stuff peculiar or specific to our order management system, and so we want to test a few versions of our order management systems to see which is best suited to the markets. Building a simulation is tougher and actually way more interesting than you might think. In section 7, we jump back to some fairly rudimentary plumbing, but it probably wouldn't have made sense to build it if we weren't sure from our simulations that we were actually going to make some money. The plumbing we're talking about is the actual communicating with exchanges to place orders, cancel orders, and get information about our fills. Fills being when other people have taken us up on our offer to trade with them. We'll look again at what kinds of things that exchanges have in common so that we can build a generic system that can trade across a whole multitude of those exchanges. The weird thing about this area is it's simultaneously drudgingly boring, but also hyper-critically important to get right. It covers everything from something as simple as how much you own or how much you have traded of each of the cryptocurrencies you're trading, to something as important as making sure you don't end up owning $1 million worth of some dodgy meme coin just because your network was unreliable. And finally, section 8, it's go live time. Woohoo! It's probably the most exciting time because you're finally trading your own money, but probably the most boring time because you're simply going to be confirming what you already know from simulation. You did do the simulations, right? All that really matters at this point in time is have someone who wants to be a trader sit with parameters like how much risk they want to allocate to each of the algos so that they can optimize your capital expenditure. For example, you need to do trade-offs like you might be making fortunes trading Luna, but when the rugs get pulled, do you want to be holding tons and tons of Luna just because you're making money with it every day? There's a trade-off between how quickly you're making money and how much money you can lose at any given time. That's pretty much the responsibility of a trader. They sit watching these things all day. Generally speaking, the algos will look after themselves, but it's always good to have someone there just in case there's an opportunity in the market or in case things suddenly go badly wrong. This week, FTX. So if this roadmap excites you, please remember to subscribe, hit the alert button, all that yada yada. But please also remember to tell anyone you know who might be interested in this channel, because I don't think I'm going to go much further than the next 8 episodes, this basic overview here, unless I can feel there are a lot of people interested in the topic. I love teaching, but I only want to be teaching if there are people to teach. So please, make it happen. And with that, fellow hackers and traders, this is Dr. J signing out. See you next time. Ciao.